Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today is Tuesday, March 28th. Today we have Chen, Zhao, and Ira Harris. Chen is the Chief Global Strategist of Alpine Macro. From 2015 to 16, he was co-director of macro research at Brandywine Global Investment Management. And prior to that, he spent 23 years at BCA Research as partner and managing editor and chief global strategist. He developed and wrote BCA's China and Emerging Markets publications in the 1990s. We also recently did a podcast with his colleague Caroline Miller. Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thank you.
Thank you.
Great. I thought we begin, Chen, with your macro view on the global economy and the financial markets, and maybe if you wanted to do a focus on emerging markets as well.
Sure. In a very broad sense, we have basically taken a constructive view on the U.S. stocks and bonds. The reason for that is that we do believe that the Fed has probably done enough in terms of monetary tightening. And of course, this regional banking crisis further validate that view, because we don't believe that the U.S. equilibrium interest rate is as high as a lot of people are saying. Actually, when you talk about the R-star, which basically saying the real equilibrium real rate, I think we're still in a declining trend, simply because the steady state growth rate in the United States actually post-pandemic is probably lower than pre-pandemic, simply because of the labor force being shrinking actually relative to the trend. So if you take that into consideration, I think we're done in terms of monetary tightening cycle. And of course, lots of people are talking about earnings recession. Everybody was talking about earnings recession that is going to come along. My experience with the financial market is if everything becomes so obvious, usually it's not. So I would say, if you look at 1974 experience, once the Fed stopped tightening monetary policy, stock market started to take off, even though the earnings recession happened afterwards. So I think we'll probably have the similar kind of a situation playing out going forward. So bottom line, I think the economy is going to be probably in some sort of recession. We're going to have a credit crunch as a result of this regional banking crisis. And that actually will help fighting the inflation. I think the disinflation process will probably quicken. And you put all this thing together, I think bonds yields will probably continue to be on the downside, and stock prices will be probably on the upside in terms of path of least resistance. So that's my quick view.
Interesting. And your thoughts, Ira?
Well, I agree with 99.9%. I'm not even sure where I disagree, but nothing's 100%. But Chen's comment about what seems so painfully obvious, and I know from where he emanates from BCA, and you see things and you go, well, how come nobody else is seeing this? And one of the greatest technicians that I know, and I know him well, I used his services for years and years, probably 25, 30 years or more. And he would constantly remind me, if you're right at the wrong time, you're wrong. So we keep relearning this, right? And so I agree. We are in this situation, and it's interesting. This is where the Fed loses to me one aspect. They lose their credibility in a lot of spots. But now all of a sudden, financial conditions are tightening. And Powell acknowledged that he says, we're seeing a tightening that, what did he say? The exact words were a little bit different than what, everybody's come to rely on with looking at the S&Ps and going, well, the S&Ps are up today. Financial conditions must be looser, but it's so far beyond that, and that they need to start paying more attention, because I think that Chen is 100% right. We're going into a credit situation, good, better, and different, because we know we have all this debt that's going to roll over from basically 0 to 1% range and have to be paid for, and that's going to tighten conditions. And we've already seen the impact. The Fed could never see this because they would just fail to realize how much leverage there was in the system due to their continuation of ultra loose monetary policy, whether at zero rates or, of course, it's only a month ago. I'm sorry, it's a year ago that quantitative easing officially stopped in March. So even when inflation was showing itself, so now we're here and we have to deal with it. But I think that when you really look at financial conditions, they've tightened far more than the Fed wants to admit. But we'll go from there.
And just coming back to your thoughts, Chen, on the path of least resistance for equities, how do you see emerging market assets playing into that? Will the financial crisis currently being experienced negatively affect those assets?
That's really a call on the dollar. If you look at history, it's the same call. It's the flip side of the same trade. If you think about the dollar going down, then you want to be long international stocks. I think the logically, if we believe that the Fed is done in terms of monetary tightening, if we believe that the U.S. economy is going to soften substantially, if we believe that disinflation process will continue, logically, you would think that the dollar probably should be on the softening side. Okay, so that's usually is good news for emerging markets. Not to mention that you have a China reopening process that is also in motion. That is also a positive. But the problem here, I have a problem with all this notion here. All this is widely written, known, and probably discounted by the markets. I mean, look, China reopened trade. Everybody was, was very bullish on that. Everybody was in that. And yet, if you look at Chinese stock price performance over the last months or so, it's total disaster. It came down. Nothing went up. So where's the China reopening? I think the reopening trade already happened from November all the way to January. That was a big rally. We talked about Alibaba, went up like almost 100%. Now everybody was gung-ho on that trade. It's too late. So all I'm saying here is, again, you need some new impetus behind all this big theme. For example, right now the dollar actually has this pretty stable. I mean, you have to have some kind of a economic slowdown in the U.S. I think it will happen because the credit crunch is going to happen. Right now, you can see the regional bank loan books are shrinking. You can see their deposits are fleeing, going somewhere else. It's inevitable that you have a third of U.S. financial intermediation is done by the regional banks, and then these regional banks are in contractionary mode. So you will have an economic slowdown. When that happens, the Fed will have to stop and react, and then the dollar is going to go down. When that happens, most likely the stock prices in the emerging markets and commodity prices are probably going to start to react to that. So right now, we're still a bit of an early. The story was widely discounted, known. Everyone was afraid of U.S. equities moving into the international stocks. Now get burned because banks, the European banks are got into trouble. So you need new policy impetus in order to reestablish the trade. So meaning, I think 6 months, second half of the year, probably emerging market probably do better, but that is predicated on the fact that U.S. economy will have to be much softer than now. The Fed has to be chicken out or pivot towards the dollar side, and the dollar start to weaken. So that's how I see it.
So you see the timing process as going on in the next 6 months, or?
Yeah, right now the emerging market, China reopening, trade, that kind of stuff is too crowded. Everybody's in that story. I mean, a month ago, you ask anybody, "Oh, China reopened." Yeah, yeah. It's dumb, man. It's already discounted.
Interesting. And your thoughts, Ira?
Well, I can't disagree with that. I think there are selective places because, again, we have seen the emerging markets hold up far better through this period than we. I mean, I've been around in university back in the 70s and actually studying these types of things, called them less developed countries back then. And we see Mexico. Mexico has been an unbelievable story. Now, we know the story is partly, of course, due to repositioning of supply chains. And that's what NAFTA, until China stole Mexico's thunder when they depreciated the yuan on January 1st, 1994, from 5.8 to 8.7, and stole a lot of the emerging markets thunder, but especially Mexico, because NAFTA, it's, as we always talk about, that was the same day that NAFTA started. No coincidence. And China was very good at really cutting the rug out from under Mexico. And you saw what happened. A year later, you were in the so-called tequila crisis, and Mexico, the peso's gone from 4 or 5, 6 to 1 to the dollar up to 22. And now we're sitting back at 18 and a quarter, which is pretty good. So the peso's been going up, but a lot of that, the emerging market, even Brazil, and Caroline Miller, when we did the podcast, and I disagreed on it because I think Brazil is a better story. Even with Lula, I think Lula is a very sophisticated player on the global scene. He's kind of putting it together and understands, and he's got the biggest grain consumer in the world, and he plays to that, of course, to China. Brazil is just, it's like China's bought all the farm. They don't own the farmland, but Brazil just farms it and everything heads out to China. So that's been a pretty good story. And the emerging markets have really held up far better than we've seen under all this stress. And, I can argue the Mexican banks, the Mexican politics, I think the currency and the economic story has run way far ahead of the politics. I'm still very bullish Mexico, but I think the politics with AMLO and getting the drug cartels under some type of control and, of course, the corruption. But the emerging markets really are and have held up better. And I think that's what makes people pay a little more attention to them, because we haven't seen this. We just have not seen this. So there is a shift. And Mexico and some others have been very good at, of course, being able to issue bonds, not just in dollars, but in the domestic currencies, which I think has helped them tremendously, which is why they raised rates ahead of the Fed. I think, in some ways, they saw what was coming, and we saw Mexico go to 5, 6, 7, 8, 9, 10% without waiting for the U.S. They were moving well ahead. Brazil shifted from 2% to, I don't know where they're at, but substantially. So I give the emerging markets quite a bit of credit. And, no small impact also to, I think, one of the better central bankers in the world, Augustin Carstens, at the BIS. And I think he knows to listen, and he knows the way it works. And I think he's been a really good source for that.
What are your thoughts, Chen, on some of the Latin America markets?
I totally agree with what Ara is saying. I think the part of the story actually is 98 crisis, emerging market crisis, 2000, the Brazilian, Turkish crisis, all of that crisis. Basically, led to the delink of their currencies to the dollar. So that actually gave them a lot of flexibility. But in old days, every time Fed raises rates, they're all toast because they gotta raise rates at the same time because of the currency pact. Now that they don't have to, it's really their own call. The question here is really alpha, whether the outperformance, underperformance, how to get, are you better off in the U.S. or are you better off in emerging markets? So far, all I'm saying is, so far you are indifferent in terms of performance. Either you're in the U.S. or you're in EM. I'm more talking about since the beginning of the year. So it was better if you were in European markets, but that been taken away because of the massive haircut in the banking shares, because Europe has a lot higher bank concentration in the index. So all I'm saying here is, if you think about alpha for performance, you need EM as a whole to do a lot better than the U.S. And the precondition for that is a weaker dollar. That's all I'm saying. I have no doubt of what the era is saying, that their economic fundamentals today are totally different from the 90s, or for that matter, 2000. They've straightened out a lot of things. Their debt level is low. Their current account much improved. Their fiscal balance is way better. The currency is very flexible. The inflation is even lower in some countries than the U.S. So good fundamentals, but we're talking about the outperformance. We're talking about alpha. To have higher alpha, it seems to me, I could be wrong totally, but I think historically speaking, you need a dollar to soften in order to generate, in order to produce that alpha. For us, for dollar-based investors, I got to be clear on that too. Yeah.
And are there any specific emerging markets or countries that you like better relative to others?
I think if you have a dollar view that actually consistent with what's going on in the economy, meaning that the Fed is going to pause, pivot, blah blah blah. Basically you're going to have a dollar probably on a weakening side the second half of the year. If that is the case, usually that's good for commodity plays. That's usually good for LATAM. Not to mention that you already have pretty good fundamental, as Era is saying, that look at Mexican peso got a very high carry, very stable exchange rates already there. So if you put that into consideration, I think that some of the commodity stories will continue to work out. China is a bit of a problematic because of the geopolitical problem here. You never know what the U.S. is going to do with some of the publicly listed companies. But I think the reopening story, the first tranche of reopening story being discounted, no question about it. I mean, Alibaba was what, $60, moved up to what 90 or 93, 97, and now back down to about 70. I don't know, that I haven't checked recently. But all I'm saying here is the process is still ongoing. So some of the Chinese shares probably want to do better. But I think that the cleaner story is that if you have a weaker dollar, stronger commodities, LATAM usually wins out.
Mm-hmm. Your thoughts, Ira?
No, I agree with all those. And on the weaker dollar, we saw that when the dollar ran up on, again, I hate the dollar indexes, but it's the only proxy, when it went up to 113, 114, you really saw some of the fragility that was starting to raise, and it forced the emerging markets to raise a little more aggressively, I think, earlier on in the cycle, because they just did not want to get caught in that typical, events where people ran away from it, and they seem to weather it better because, again, when the dollar gets that strong with the huge amount of dollar borrowing around the world, you see how the conditions tighten. And we didn't see it as dramatically. In fact, the dollar really needs to weaken against some of the more developed markets. And I was kind of surprised that the G7 sat back and watched this unfold when nobody wanted to raise rates, and the Fed was raising rates and the dollar was pushing higher, and it was causing all kinds of stress. Now we've seen in the last week, minimal amount of stress really in the global financial system. I mean, yes, we've seen two medium-sized banks, and we've seen what I would argue has been a terrible, terrible, all I do is have to look at the chart of Credit Suisse to tell you that you can't be surprised. There were people way ahead of that, and I'm not just talking about in the CDS market. The price of the stock had been going down for 5 years. It was a massive underperformer. So we've seen that, and with this, you have to be careful. And dollar, and you saw already the Fed and the Treasury moved to open up swap lines to try to get in front of this in case anybody needs, dollar funding on a short-term basis. So they're a little bit worried too. And and again, we'll come back to the European banks. I have a feeling because they are weak, but we'll get into that. But the dollar really has to, and that's why I didn't understand why the Fed is, they claim to have a dual mandate, but they'll always live within the Triffin dilemma, which gives them a triple mandate, especially when you're the world's reserve currency. You can't hide your head in the sand and pretend, well, it's not. You're going to wind up with great figures in a very fragile global banking world. So, the markets will do the work if the Fed would let them ever.
And coming back to China, Chen, on the question of investability in Hong Kong assets, is that something you're comfortable with? Are there any concerns or issues? Do you see the potential for capital controls imposed, more by the West, by the U.S.?
The risk is asymmetric. What I'm talking about here is that you really have to be concerned about the risk of the U.S. side, because what the American politicians or Congress or whatever the government wants to do to control your money flowing into the Chinese assets. Whereas I just heard from the Chinese side, they just, saying, no matter what, we're going to open up the economy, we're going to open up the financial system, we're going to deepen the reform. That was the message they sent out as of yesterday. There is a forum that's being held in Beijing. You probably know that Tim Cook is there, Rick Dalio is there. It's a very different approach. So the way that the U.S. is fighting this competition, China-U.S. competition, is by basically trying to restrict the flows to the Chinese company, try to kick out all these Chinese companies, like a TikTok and national security, stuff like that. Whereas the Beijing try to fend off by only one way that they can do that, to fend off this this is sort of a competition or challenge, which is to make your economies more open and create more business so that you can fight off this protectionist wave or hostility. So that's what I'm saying. The risk is asymmetric. I don't see that there's any risk the Chinese government is going to shut its door and confiscate the foreign capital, foreign assets. No way. They're going to make it much easier, much friendlier to foreign capital. That's the way to fight this war. Whereas you have to be concerned and be careful of your money with the U.S. government. Well, lots of restrictions, lots of tariffs, lots of stuff like that. So that's what I'm saying. The risk is completely asymmetric. So I think nobody should trust the mainstream media. There's completely biased. Nothing good coming out of China, which I don't believe. Nothing. That's a total nonsense. So investable or not, of course it's investable. For whom? If the government disallow you to invest, disallow American citizens' money, capital flow into Chinese communist controlled assets, then too bad. It's not investable, but it's investable for everybody else. Just.
Yeah, that's interesting. Good points. Your thoughts, Ira?
This gets very interesting, and Chen brought up the mainstream media, so I'm going to dance around that a little bit. But
Yeah.
What the United States has to be careful of, and you see the friction between Europe and the US over the most misnamed piece of legislation in the history of mankind, the Inflation Reduction Act. But there's so much pushback from Europe because they see it for what it is, which is a grab for more high-tech industries. And how? Because they will create a tariff, almost like if they were putting carbon taxes at the border, right? We've discussed this for so long, and China saw through that with what Europe was going to do. And China is going to slice off pieces of the West one by one, because we've talked about this, and I have a very good friend, Kevin McCarthy, not the legislator, but somebody who I went to graduate school with and is a really, really good global macro thinker and has been for 50 years. As he points out, Germany is so reliant on China. Germany's amount of business that does China. So China will slice off Germany, and Germany will take the rest of Europe, because Europe without Germany is in very, very dire situations, because Germany carries the credit card for the whole European system. So you're not going anywhere without them. And the United States has to be very, very careful, because everybody sees the fissures. Putin sees the fissures. Xi, they're not just talking about the Ukraine. When Xi and Putin get together, there's so much more on the table. And then, then we get, as Chen says, then the media raises Taiwan. Well, I go back to 1971. I was fortunate back when I was in graduate school to study under one of the best Chinese political scientists in the country, Ed Friedman, and he would preach at you. There will be the United States has already in 1971 determined that there would be no thermonuclear war. And I hate to use that phrase, but that's what we're talking about with China over Taiwan. Wasn't going to happen. It's not going to happen now. The rhetoric gets raised up. For what purpose? It's purposeless. 2 years ago, 3 years ago, they were screaming about Hong Kong. And I saw that interview. It was kind of disappointing with when he interviewed Kissinger, the history professor from Harvard, who I really like. I can't think of his name for the moment. But when he interviewed Kissinger, all they talked about was Hong Kong, which I thought Hong Kong's a sideshow, because that was going to return anyway, right? That was what the original treaty. It was a sideshow. Taiwan is always the main issue. And I think the rhetoric and some of the politics, like Pelosi going there, or just silly. Why are you raising the level when you want to kind of bring it down if you're really in the middle of trying to resolve some potential global hotspots? So I agree with Chen. It's just, China is a long, hard, drawn out story. They have a much longer timeline than we ever play with. So they will see things through. And you're not, and if you think you're going to shut them out, it's a bad, you got more hot air than the balloons that supposedly float over the country all the time. But I don't think so.
Actually, on that note, do you think that the U.S. could sanction countries trading in yuan currency? Chen?
Don't know. U.S. can do a lot of things, but I think the Chinese are walking a very fine line. I don't think they raised the issue that China would supply weapons to Russia. Of course, there was no way that they're going to do that. Why they risk economic relationship with the rest of the West? With the U.S. and no matter what you do, you can't please the U.S. politician. They already take the predisposition that China is an enemy, is a national threat. When you think about all this national threat, where the national threat is, you're basically talking about 4 issues: South China Sea, Taiwan, Hong Kong, and Xinjiang. I mean, these are 10,000 miles away from the United States, but how the hell that becomes the national security of the United States? How Xinjiang become national security to the United States? How South China Sea become a security threat to the United States? How Taiwan become that? How Hong Kong become? It's become a joke. But anyway, most of the Chinese believe that this is
Yeah.
this is a two power that is in competition. No matter what, they're going to figure out a reason to knock down the other. Whereas I think the Chinese side basically are not really in for a fight. They try even today. They tried every possible ways to be friendly with the Americans, but hey, all the politicians there from Mark Rubio to I mean, these guys have never been to China, never been to Asia probably in his life. So take a very hard line approach to the communists. The problem here is when you frame the trade issue the way that we want to only deal with the countries with the same that shares the similar value, then you're framing the world in a way that is impossible. That is impossible to deal with. You're really talking about regime change, where the Communist Party took control of that country 70-some years ago, probably another 30 years it will still remain in place. Then how are you going to deal with it? So that's why many politicians in the United States have framed the issue in an impossible way to get out of it. So I think I don't know how this thing is going to end. I have no idea, but the way it goes, it doesn't look like it's. But I think the Chinese figured it out. They are smart enough to know that they are still behind in technology. They are still very much behind in military. They have basically controlled their military spending at a very, very minimal level. There's 1.4% of GDP, whereas the US is about 3 and 4% of GDP. So they're trying to not scare everybody else around them. In the meantime, I think the tactic that they are using, the strategy they're using, is to make the domestic economy much more open to foreign capital. That's the most effective way to fend off this tech blockade. So I'm not sure where we are going in terms of the conversation, but I think this fight is getting. Sometimes I feel that the fight is getting a bit of a absurd. The whole thing started in the pandemic. Remember that even Donald Trump calls Mr. Xi Jinping his friend, his buddy. And then when the election came, 2016, and then he was under pressure, and then he basically slammed the Chinese for all the mistaken problems in the United States. And that's how the whole thing went downward spiral. So there's certain unfairness, but the politics is never fair, but it's what it is. It's what it is. So
that's good observations.
Yeah.
Your thoughts, Ira?
Well, especially when it comes to Xinjiang and issues like that. I mean, I sit here and I watch who's dealing with China. Iran. And Iran poses as the great protector of all things Islamic in the world, right? Because until they get control of Mecca and Medina, which they still salivate over, because until you control those, you're not really a caliphate. But as they set up the Iranian caliphate, and who's dealing most with China? Iran. And you go to Xinjiang, Xinjiang, and this is truly not a political statement, it's just reality. Xinjiang, going back years when Stalin had his eyes on it, because they've known about the mineral richness, especially of the Xinjiang region in northwest China, and the Russians were aware of what was there, wasn't going to happen. So the Uyghurs, and I'm not belittling it, are in the same position as the Lakota Sioux were in the United States in the Dakotas. Once they realized what was in the Dakotas, and the world went about its ways. Unfortunately, that's the way the world works. And that doesn't mean that I'm talking about a genocide. We throw that word around in ways because it's a convenient and it raises a lot of immediacy, especially in the in the world that we live in, algo-driven headlines. So that's the Chinese are never going to walk away from Xinjiang. It's much too significant for the Chinese growth story for the next 100 years, and I'm probably low on that. So I think Chen talks. That's right. So you better come up with something better. And interestingly, Hank Paulson wrote a piece recently for Foreign Affairs, not the big issue, but the daily issue that or the shorter issues that they put out, stating the case. Now, this is, of course, a Wall Street view, but how you have to find some commonality and find those places. And there's a big part of this country that thinks that way too. Right now, the Trump view was to play, and not wrongfully, by the way. There was a whole part where, I'm from Chicago, my whole life. So I understand the hollowing out of the American heartland, but that was all part of the globalization process from the 90s on forward. And everybody has a piece of it because nobody did more to forward that and advance that than the Clintons. And of course, it was George Bush who really started NAFTA, the process of NAFTA, but all this was done under the Clintons, so much so that even in 1998, when Bill Clinton took a group to Shanghai, to Beijing and Shanghai, the Japanese have still not gotten over it because there was no stop in Tokyo, right? They went right to China. He spent, I think, a week in China with big American corporate leaders, and that's what they did. And Japan is still over that. And not only that, right before, as the trip was commencing, the Chinese were not happy with the weakness of the yen, which at that time was about 135, 140 to the dollar. And they were complaining, and lo and behold, the U.S. Treasury moves to intervene to strengthen the yen. Not a coincidence. So you have these relationships. Everybody, there's good to it. There's been some negatives. The politics of America have, with Trump, even as close as he tried to get to Xi, he had some issues, of course, because his entire the backbone of his support in 2016 was what Hillary Clinton called the deplorables. But those were people who were really who bore the brunt of the burden of globalization, and they needed a voice, and Donald Trump. So, and now the voice continues because there's a lot of votes to be had there, and they still haven't worked that out. So, I think that Chen's views are right, and it'll be worked out. How, and don't know, but I sure hope that it doesn't take a war. And it's interesting where we sit now. We have Xi and Putin. But people forget, in 1979, China invaded Vietnam. Now you think about it, 1979, 3 weeks, and the Chinese army took a beating. They lost 55,000 troops, but they laid a heavy one on the Vietnamese, and then they pulled back. And I thought that if Putin did that, if Putin was going to go into Ukraine, I was skeptical that he was, it would be like that. 3 weeks, we're going to send a message. And why did they go? Because the Soviets and the Vietnamese were getting too close, and China thought it was being surrounded by the Soviets. So the world is always changing, and when we get these hardened positions, they don't do anybody any good. You have to be careful, and I think that's what Chen's warning us. You don't take this just like that.
What are your thoughts, Chen, on Japan in terms of the yield curve control and the Japanese yen currency? Any thoughts there?
I think I thought a few months ago or 2 months ago, I thought it was almost inevitable that they have to remove that, because you remember that when they implemented the yield curve control, the primary purpose was trying to steepen the curve so that they're going to help the domestic banks. So that's the original purpose of the yield curve control. Now, because of the circumstances changed, the Japanese got a bit of an inflation problem, and the tendency for the long end of the curve to go up, so that they have to clamp it down so that they become a new source of monetary easing. So it becomes a contradictory itself. On one hand, you have a bit of inflation. On the other hand, the Bank of Japan, in order to maintain YCC, they have to ease quantitatively. So at the time, I thought that they gotta remove that so that they can let the bond yields to back up. But nothing happened, and I sort of start to question whether the judgment is right. So I look at Japan's inflation as not inflation. What are we talking about? Well, what I'm talking about is if you look at Japan, it's very funny. The inflation rate is sitting on top of the Japanese yen. Okay, if you have a very pronounced decline in the Japanese yen, the Japanese inflation always popped up. Same thing happened in Abe took over the office in 2013. You can see the yen dropped 20-30% of its big decline in the Japanese yen, and then Japanese inflation popped up for a year or so. And then once the yen stabilized, inflation just crashed way back down. So I think here we go again. Right now the Japanese inflation is no higher than 2013, about the same level, slightly lower than 2013, because of the yen decline was not as pronounced as last time. Last time was a 30% decline, something huge. So that is not in my book. That's not called inflation because it's a currency. It's a currency-induced relative price shift, right? If you have a currency going down that much, you usually have a higher imported cost. In particular, Japan CPI has much higher concentration of goods than the United States. We have much higher concentration of service, and in Japan is about 50% goods. So that makes the Japanese CPI particularly more sensitive to the yen. So I think probably Bank of Japan now is I don't think, especially at the time of a crisis, the banking crisis moving from the US into Europe, I don't think any central bank would like to see that moving to their own country. So the Japanese right now, if you look at their yield curve, is still very steep. That's the only country that got a steepened yield curve. You can see the short end of the curve is still about a zero, long end of the curve is about 1 or 2% in that range. So the banks are actually getting some help. So I don't think they are in a rush to remove YCC. That's my feeling. The second thing is that if yen stays steady for a period of time, meaning not going down additional amount, staying where it is, inflation is going to crash down. It's going to come back down. This is a rate of change. Inflation is fundamentally a rate of change concept. So if your currency, if inflation was generated by currency decline, then by the same token, if the currency stays steady, inflation should gravitate back towards zero. So if you put all those things together, I don't think they're going to let it go very easily. That's my very superficial take.
Oh, good points there. Your thoughts, Sarah?
Yeah, well, I do a lot of trading in yen, and I'm a little bit bullish the yen because I think that it's cheap relative to the world and where they sit.
Agreed.
And Louis Gavay had that beautiful, when we were almost a year ago when we did that podcast with you, Richard, and Louis raised a point that the weaker yen was actually helping China. It was also helping Japan against Europe, because if Europe was going to make, the euro yen ran up to, I believe it was, let's see, where are we at now? We're at 142. It was over 150, which is phenomenally cheap. And Japan and Germany, of course, compete so directly on so many products, and they compete for the Chinese market. And I think at one point, if it was weakening, the Chinese were happy because it was allowing them to put more pressure on the Europeans. Hey, we can play this game all you want to. It's not like we're without cards. And you see, and Jen, you don't know this, but my son is a Japanese expert. In fact, he wrote the recent biography on Abe before Abe was assassinated, unfortunately. And he's running now the German Marshall Fund's Asian desk. So he's really good. So we talk not enough about it, but when Ueda came, and I said, "Wow, where are we going to go here?" Because he's an academic, which we've never seen an academic run the Bank of Japan. But I'm looking. I like the Japanese banks. I think Tokyo Mitsubishi is one of the. I know that they have exposure. Everybody's now looking at your AT1 exposure with the contingent convertibles. And, I've warned about that for years. I don't know why anybody would invest in them anyway, but I know you're chasing yield in a zero interest rate environment. You do a lot of stupid things. Minsky warned us about that long ago, but you only learn it after you've got complacent enough to feel the pain of complacency. But the yen becomes a really interesting thing to me. And the Japanese stock market, on a relative basis, compared to, as the yen weakened, corporate Japan was making just unbelievable profits all over the world, because they're selling all over the world, and they're bringing it back and taking advantage of a weaker yen, and the weaker yen is getting them into market. So I don't know. Now everybody's looking at each other's banks. So everything is on hold here because everybody's trying to figure out who's got the most risk exposure, especially to the cocoa bonds. But I go back to, interestingly, when we saw that major movement now they're blaming it on the credit default swaps on Deutsche Bank that set that up. But I thought that there was an article last Thursday, I don't know whether you saw it, Chen, in the FT by Tidjane Thiam, who was the previous CEO of Credit Suisse, basically saying this had nothing to do with me. I try to do everything right here. If you haven't seen the piece, it's unbelievable. And then at the end of it, after he tries to, as I learned to say, if you point your finger, there's always three pointing back at you. But he doesn't want that to take place. And then he said, if you think Credit Suisse had problems, take a look at the European banks who are loaded up to the gills with AT1 debt that, because of what took place. And then all of a sudden, Europe started to melt down, and it took a lot of other things with it. So I thought that I have it sitting right here. I'm going to write a blog about it probably tonight. But I think, helped set that on fire. And so I think now we're just in a pause while everybody's trying to figure out where the greatest fragility is in the system.
Yeah, I guess that would be the last question. Chen, your thoughts, like what is there contagion going to happen? Is this the symptoms of a government bond crisis or cocoa bonds, or where do you see it playing out, and the effects on the US dollar in particular also?
I think the Fed has probably look at the Fed balance sheet. It's just gone vertical up. So the QE have restarted. Whether they call that or not doesn't matter. The balance sheet now has gone through the roof. So last week alone, there's another $100 billion net increase, net injection. I think as the facility is being put into place, I think probably very difficult for spreading the regional bank failures, because anybody can go to the discount window using their because for example the First Republic, they basically they just find out that actually they got lots of munis in their book, and then the Fed say, okay, munis, fine, I'm taking that too. Okay. So basically they take anything, I say, hey, I got a bunch of furniture. They're going to probably take the furniture as a collateral too. So it doesn't matter. So they basically have put enough liquidity firepower to ring fence the banking system. So I don't think there could be a more failure. But I think most people, ordinary people, don't know what we're talking about. They're still yanking away their deposit from small banks. So you can see that it's happening. I'm looking at the data now. You look at this U.S. regional bank, the deposit just going vertically down. Yeah. So the vertically up in terms of Fed balance sheet just offset that part. It's not. So to answer your question, I think they will do whatever it takes to stabilize the banking system. That's why I think the contagion, in terms of financial contagion, is probably over. The next stage is the real economic consequences, meaning I think all those local banks they will, as the deposit going away, they got no option but to shrink their loan book. Local banks are dealing with the local economy. I mean, talking with real estate, commercial real estate, all that kind of stuff. They're having real impact there. So I think, the next stage is going to be not necessarily financial contagion, but more on an economic consequence that we have to deal with. And the end result will be some sort of recession. The yield curve is right again. Some people talk about no lending. That's nonsense. Now look like pretty superficial, and even look like a little bit of a comical talking about no lending. But hey, this is how I see it. The European banking system is much worse than the US, actually. They are much more leveraged because the banks, this is the leveraged business to begin with. I mean, if you don't want bank to have any leverage, then don't have a bank. You don't have a bank. I don't care how much equity capital you have. If you have a run, you're toast. So I think the European banking system is still will be tested again, even though they try to do different things. But ECB has to, at the end of the day, who can stop a banking crisis? The central bank. As long as the central bank can guarantee your liquidity, the crisis be over, literally in a minute. So if Lagarde continue to talk very tough, that's not a good thing. I know she needs to chicken out. Come on, you got Deutsche Bank is in trouble. Credit Suisse in trouble, who knows what else, right? So you basically have to say, hey, the central bank is to stand by. If you have stress, we're gonna make sure that you're gonna have enough liquidity. So I think if you have any contagion financially, you probably should look for look to Europe for potential more trouble. But I think U.S. we're into a real economic adjustment phase.
Mm-hmm. Great. And your final thoughts, Ira?
And that's exactly what Tijan DM talked about, but coming from him, he was just pointing fingers. Not his analysis was not nearly this deep as Chen just laid out. And it's interesting because as I've been putting together a blog in my head, I have this phrase written down that I'm going to use. And once you start talking about contagion is, this is what I write, is the bulwark of tightening financial conditions. If you're talking about contagion, you are already in a very heightened stage of tightening financial conditions. It's not something you can turn your head and away from it. And we're talking about it because exactly what Chen talks about, these banks are now and are now going to have to be paying more for further deposits. Peter Bookvar put out a wonderful piece about it, doing all the math. And I know myself that I've taken money. Now I bank, I bank at Chase because to me, Chase is bulletproof. Because if JP Morgan disappears, we got a whole lot of other problems that we're going to have to deal with. So and I've been telling people that, but of course, JP Morgan paid me nothing up until recently. Now all of a sudden I'm getting 4% where I was getting nothing because I told them I'm leaving, a few months ago. But it'd be funny because I would walk in with my deposit because I still go to the teller because I'm too old. And I would hand him my check for deposit and I would put up my hands because I go, I know who's robbing who here, and the tellers, we would have a good time and laugh about it, but it's true. And that's going to bite into them. And Chris Whalen has just been all over this. So everybody, we're all seeing it again. We're right at the wrong time. We're wrong, but you saw the movement and all of a sudden we know, and Richard, you and I have done a few podcasts where I've brought this up. The inversion of the curve was so dynamic. And now we know why, because nobody was selling the long end because they couldn't sell the long end. So everybody was selling as the Fed talked more hawkishly. across the board, whether it was regional presidents or Powell or not Brainerd, but we'd hear from others. Everybody took the easy route, which is to sell the short, to get short the 2-year note as a hedge. So we went to 110 inversion, and I'm looking at it. And then all of a sudden, the worst thing happened is you go into a banking crisis. The last thing you want to be is short 2-year notes if you're heading into any sense that there's a banking crisis, especially when the hedge funds were just pushing because it was a free ride. It was a free ride, and they kept pushing it. And then all of a sudden last week, when we saw, or over the last 10 trading days, when we saw the 2-year go from 5.2 to 3.8, that was more, I think, loss taking, and they found those positions to be so easy to put on, not so easy to exit from when everybody's in the throes of a potential real crisis in banking. So all this is going on. You got to be careful because, again, the headlines drive it. But I think that Chen's points are about the underlying fragility is real. How it gets resolved, I don't know. The Fed could resolve it today. They could resolve it today, and they could take basically a BOJ stance and go, look it, we're buying unlimited 10-year and 20 and 30-year U.S. Treasuries.
Right.
And here's what we're paying, 2.8%.
Okay.
We gave them to you. We'll take here's our bid. But I promise, I hope I'm on gold if that were to happen. But they could resolve this without a FDIC. They could resolve this. But of course, the banks would probably hold off for 2.5% because they'd be so stupidly greedy that here they're giving it out and they wouldn't even take the out. But something like that may wind up being done. And Chen talked about it with yield curve control in Japan. It wouldn't, I'm not sure about how it goes here, but if those banks are going to delever themselves, I don't see any other way.
Mm-hmm. Well, great. It's been a fascinating, interesting discussion. How can our listeners, viewers learn more about your work, Chen?
Sorry, I did not catch your question, Richard. So what did you say?
Oh, just how can our listeners, viewers learn more about your work?
Well, go to www.alpinemacro.com. That's got all the information that you need to know. We're basically independent macro research firm dealing with the capital markets, foreign currencies, and bonds, anything that move around.
Yeah, great. And, yeah, and great. Ira, you're.
You can find me at Silicon Valley. No, in the typical sense of, I'm writing a little bit more. So Notes from Underground is where I blog at. But right with you, Richard, these podcasts, I think, and here we get to sit down with Chen and really discuss things. I think these are worth their weight in gold because whether you agree or disagree, you should learn something.
Yeah. Exactly. Thank you so much, Chen and Ira. Thank you.
Chen, it was a great pleasure.
Thank you. It was a great pleasure.
Yeah. I hope we can
have a lot
again. Thank you.
Take care.
Bye now.
Bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.